Hello, everyone. Today on the final bar, I'm talking to Bob Lang from Explosive Options. We'll look at some of the breadth indicators that are top of mind for him as this choppy market environment continues. The S&P was sort of weaker in the morning, accelerated to the upside after lunch, and then settling back down right around that 4,500 level. So if you love volatility and uncertainty, days like today just continue to push that on. Two top sectors are interesting, though. Healthcare, number one. We've seen a lot of renewed strength in healthcare. Energy, number two. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a sunny and warm Redmond, Washington. Thanks for joining us every weekday after the close as we break down this market environment using the technical analysis toolkit, trying to better understand investor decision-making, investor behavior by looking at the message the markets provide back to us in the form of asset prices. It's been a choppy environment by any stretch. Year to date has had its ups and downs, regardless of what chart you're looking at. This week is, I think, continuing to sort of raise question marks. I don't know if many questions are being answered this week, but certainly seems to be raising more question marks. You have breadth conditions that are fluid. You have signs of strength from individual sectors like healthcare, swinging to new highs today. Utilities recently coming off of a new high. On the other side, you have sectors that are rolling over and stocks that are struggling. I'm thinking about Goldman Sachs and Morgan Stanley, other financial firms that are making new swing lows. So, which is right? What's the right tell? Is the market overall in a position of strength or weakness? And I think the answer is yes to both of those. And it depends on where you look. We often talk about a stock picker's market. I think this is one by most definitions you could make a valid point of saying that that's the case. There are names that are working just fine. There are names that are struggling. And the major averages are according to netting out to a flat sideways trend here in the short term. We have great guests on the show. I'm excited to talk to Bob Lang here in a little bit. Next week, as a reminder, I'll be off. I'm taking a vacation down in Oregon with my family. I'll be presenting to you every day one of the 5 hidden features of StockCharts. We're just finishing those up this week, and we'll share with you every day a new hidden feature, an area of the platform that I think is underappreciated, that can add value to your thought process. I'll share with you each one of those every day at 4 p.m. Eastern. So please tune in for that. The week after, we have a couple of really good guests already lined up for you. Jesse Felder from the Felder Report is joining us on Tuesday the 19th. Tony Dwyer from Canaccord Genuity on April 21st. Let's continue on our show today with the market recap. Let's look at how things are playing out. I mentioned it's sunny and warm in Redmond. We're highs in the 70s today, which is very unusual. We go back to the 40s, I'm sure, in the next day or two. So let's not get too excited. And the market, same thing, having sunny days and cloudy days back and forth. It depends on when you look at the market. Even today, the S&P trading lower through the course of the day. And it certainly felt like there was this follow through to the downside from some of the uncertainty, some of the choppiness that we've seen in recent days. Earlier in the week, obviously, we've had some pretty big distribution days. However, market turned pretty quickly in the afternoon, accelerated back to the upside. End of the day, S&P netted out right at 4,500, almost to the penny. It's about 0.4% higher than where we were yesterday. The Nasdaq essentially flat for the day. Mid caps and small caps both underperformed the S&P, with a mid cap index, the worst of the three, down about 0.2%. We're going to talk about sentiment later in the show today. And the VIX was off a little bit, right around 2150. But again, above 20 in general is what I tend to think of as a more volatile market regime. And I think that's what we will continue to see here. Looking at some other asset classes very quickly, you have interest rates shifting quite a bit. 10-year and 30-year yields actually went higher, and the short end actually came off. So it's a bit of a steepening of the yield curve today. Bond prices actually came down using the TLT. So those are long bond prices, down about 0.75%. The dollar index up just a little bit using the UUP. Commodity markets mixed essentially, but overall netting out positive, with gold and silver both higher. Oil prices flat for the day. Energy ended up being the second strongest of the 11 S&P sectors today. Cryptocurrencies, I was reading about the new crypto bull, or the Miami bull. I don't know what we're calling the The second market bull, which has the glowing red eyes down in Miami for the Bitcoin conference that's going on here. I don't know if that's a topping signal for cryptocurrencies or the sign of the next big move, but it's a sign of something. We will look back at this unveiling of the crypto bull in Miami. If you don't know what I'm talking about, Google that one and enjoy the pictures of a new digital version of the Wall Street bull in New York. Cryptocurrencies in general up a bit today, with Bitcoin up 0.5%, Ethereum up 1.5%, but overall sort of digesting the distribution phase that you saw yesterday. Let's go to a chart of the S&P 500 and look at how today's trading fits into the big picture. The last couple days, we were actually just toying around with the 200-day moving average is the way I would sort of describe it. You had yesterday's down close, closing back below the 200-day moving average after breaking above it third week in March. Back today, we're closing right back above there. You could argue today's a bullish engulfing pattern. It's not ideal because ideally those are big, long days, but bullish engulfing patterns where you have a down day followed by an up day. Day two's range between open and close engulfs the range of the first day. So I think technically you could classify this as a bullish engulfing pattern. So bullish engulfing pattern happened right at the 200-day moving average. Usually suggests a bit of a short-term pop, so I wouldn't be surprised if tomorrow bounces up a little bit, and then we'll set ourselves up for being completely confused for next week, which sounds about right. As I head out on vacation, and I've promised my family I will try to look at the markets very little, if at all, next week as we're going out in the woods and breaking a bit. It will be tempting though just to see how things play out here. And again, when you shouldn't be afraid to take breaks from the market. And in general, all I would tell you is focus on key levels. You can set alerts. You can set stops, you can set triggers for whatever might happen. So think about the potential scenarios that could play out in the next week or two, and think about what you would do in those environments. What would your portfolio do if next week the S&P rallies above 4,600 and accelerates up to 4,700, right? Are you positioned for that sort of reality? And if not, what would you need to do to your portfolio to feel better in that environment? Are you, positioned more for a downdraft? What would happen if the S&P would go down to 4,400 and not stop and continue below both the moving averages? The RSI would continue downwards. What would your portfolio do in that potential scenario? Think about those potential outcomes. And again, it doesn't tell you necessarily what you need to do today, but it tells you to be prepared for the fact that a lot of different scenarios could play out in the coming days and the coming weeks. I think the most successful investors I've worked with think of the market in terms of probabilities, not in terms of certainties. It's not this is going to happen and this is how it's going to play out. It's more these are the different things that could happen, and here's how I'm going to position myself given some of those different potential scenarios and the uncertainty we're seeing right now. Worth noting, I think what caught my eye reviewing this first thing this morning is I always like to look at where we're at right now relative to where we've been. Right now, after chopping around quite a bit, we're back at 4,500, which is where we were in mid-January. That was after that first big leg down after the most recent all-time highs first week of the year. We're sort of halfway through that initial move down, and that's where we're at right now. So all of this choppiness, all of this movement has essentially gotten us nowhere in a longer-term sense from where we were, almost 3 months ago now. Let's go back to the dashboard and see what other themes and patterns we can find here. In terms of sector movements, you had healthcare number one, the XLV, the top performing sector, up 1.9%. Energy number two, and then consumer staples number three. One thing that's concerned me in recent days in general has been the general outperformance of defensive sectors. Yesterday, our 3 and 3 charts were 3 defensive sectors that were all showing improving price and relative profiles: consumer staples, utilities, and real estate. Now, UTS and real estate were down just a bit today, but overall, you can see the larger rotation away from some of the cyclical sectors, some of them, and into some of those defensive sectors. We had conversations about each of those sectors, I think, at times in the last couple of weeks, and those performance trends are continuing to play out. What does that mean for the market when defensive sectors are leading? Not ideal situation if you're bullish and seeing some of those defensive things at the top. I want to dig in just a brief moment to some of these sectors and look at some of the names that have popped up here. When you look at the XLV, it's worth noting today we made a new 52-week high for the sector, new closing high as well, getting right to around 142. Healthcare is up 2% today, top performing S&P sector. What impresses me more is the fact that it's regaining all-time highs. It's after making a new high at the end of December, rotating lower, and now chipping away at those losses and regaining the all-time high. The relative strength has been steadily improving since November. So it's worth noting some of these sectors where the relative strength started to really improve back in November. This is when a lot of the growth sectors started to top out. This is when the a lot of the indexes actually topped out, even though the S&P made a new high in January. Others like the Nasdaq, I want to say, made a peak in November. A lot of breadth conditions peaked out in November. Things like healthcare, utilities all bottomed out on a relative basis in November into December, and from there started to rotate higher. Healthcare is making a new 12-month relative high today. When you look at that sector, there are a lot of different parts of it. There are pharmaceutical companies, there are supplies, medical equipment. I'm thinking of charts like AbbVie when I wonder how can healthcare be doing so well. Sectors do well and they have improving trends if you have leading names in those sectors that are emerging. Charts like AbbVie are showing continued strength. It's not just a one-time thing. It's not just the last couple days thing. This has been an emerging trend that has been playing out for months now. I often get asked on charts like this along the way, did I miss the move in AbbVie back here in mid-December? My answer in general is no. Like, it's okay to sort of follow trends that are working. That should be your goal. Have some sort of stop in place. Use things like the chandelier exit strategy, parabolic systems, moving averages, some sort of trailing stop to get you out of something that's working, but don't miss the opportunity to ride successful trends as they continue to play on in that original direction. Let's take a quick break. We'll be back with today's guest, Bob Lang. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We appreciate you joining us every weekday after the close as we break down the market environment using stock charts, using data visualization techniques to better understand the investing scenarios around us. A couple quick comments before we get to today's guest, Bob Lang. First off, we welcome your questions. We had a great mailbag segment earlier in this week. We'll do another one tomorrow on Friday's show, and we'd love to feature one of your questions on the air. Our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV. Give us a follow there. And on YouTube, put a comment below the YouTube video you're watching on our Stock Charts channel. We'll gather those questions and hope to answer one of yours live on the air on Friday's show. Also, go to StockChartsTV.com. That is our on-demand platform. Knowledgeable guests like Bob Lang and others with so much experience that they're able to share with us. Also, special events like the pitch, Chart Madness from last week, our stock picking draft coming up in a couple weeks, all for free at StockChartsTV.com or on your mobile device. Just search for Stock Charts TV on demand. I want to welcome on today's guest, Bob Lang. Bob's the president of Explosive Options. He's been on the show before, always does a great job sharing some thoughts, sharing some charts that make me think a little bit more. Bob, it's good to see you. Welcome back to the show.
Thank you, David. It's always great to see you and work with you and talk about charts.
So speaking of that, we've got choppy times here. We've got uncertain times, and you're sharing with us a couple breadth indicators I think are really, really well illustrated. Talk us through a couple of these. We're starting with the percent of NASDAQ stocks above their 20-day EMA.
Yeah. So Dave, what's fascinating was this rally that this market had from about March 15th. For about 2 weeks, the S&P 500 ran up 500 points. And we really needed to, and it was pretty remarkable, right? About 12% in about a little less than 11 days. But what I really wanted to see is looking under the hood to see if this was a really meaningful rally or if it's just built on a house of cards. And where I look under the hood, Dave, is charts such as the one that you're looking at right now. Now, this is a NASDAQ, of course, but I want to see, how well are stocks performing above certain moving averages. So in this particular case, I want to see how well the NASDAQ is doing above the 20-day moving average. And when we see, Dave, prints below 50, and I put that blue line in there, that's kind of a sign of, a sickness or not really doing well for the markets. But when we get prints above 50, that tends to give us a good sign of that the stock market is healthy. Even pullbacks are used as buying opportunities by the dip buyers. So we had we had a couple weeks there with prints above 50, but now we're back below that 50 level, and that's kind of giving me a red flag at the moment.
It's absolutely right. And in the Nasdaq, we talked so much about value versus growth. This really tells the story of that growth, emergence of growth, really from the March lows, but now rotating back to the downside, which is a bit of a concern. The second chart I really like, Bob. This is looking at new highs minus new lows, right?
Yes, I look at this from time to time, Dave, and what really stood out to me was about 4 years ago, back in 2018, 19, 3 years ago actually, and it was the September October timeframe. This started to fall apart, Dave, when markets were hitting new all-time highs. I want to say it was around October 4th of 2018. Markets were hitting all-time highs. This thing was falling apart, Dave, and we saw it, and you can see that the new lows were just swamping new highs at the time, and it just didn't really make much sense. Well, we had this same condition happen late last year and early this year, and you can see when the breadth of the market is turning poor like this has been, far more new lows than new highs. That spells trouble, and frankly, you know what? When the markets collapsed here just a few weeks ago, before we rallied, you know that was it was showing that the breadth was certainly very poor. So lately, right now, we've seen decent breadth of prints above that box, but the last couple of days, Dave, we saw prints below that into that box, and if it continues that way, there's trouble ahead.
Yeah, it's hard to imagine the market being able to build any sort of upside momentum when you have a bunch of stocks making new 52-week lows. It's a
That's
great
right.
illustration of that conflict. Your last chart's looking at the VIX, but the VIX for the Nasdaq 100, right?
Yeah, so this is the VXN, the VIX for the Nasdaq, much more volatile than the regular VIX, Dave. And what we see here is we see this bounced just a few days ago off of that 200 moving average, which is the black line, but it's still trapped below the 50-day moving average. So we're kind of in a bit of a range over here. However, when the VIXN, as I call the VIX, VXN, the VIXN starts to really rally, it makes higher highs and higher lows. It'll get above that 50-day moving average. So I think it's just a matter of days. And then when that happens, the Nasdaq is in trouble once again. So we'll see some negative price action, some bearish price action on the Nasdaq if this starts to run. As you can see, when it broke out in January of 2022, you can see it on the chart there, in the middle of the chart there, Dave. And when we broke above that blue line, it really surged, and we could see that happen one more time. I'm not entirely bearish on the markets, Dave, but the indicators speak to me much as they speak to you.
And it's interesting to notice at the bottom, you've got the MACD, and I can't help but notice it's giving a potential, a buy signal, right? Suggesting, just confirming that the VIXN is rotating higher. So given that, I mean, given that there is some potential weakness there in the growth areas of the market, which you were highlighting there, what do you do in this sort of environment? I mean, how do you think about being positioned where we're sort of in this no man's land? If you're not owning growth right now, do you rotate to more defensive things, or is it more of the cyclical stuff like energy that's had a pretty good run overall? Where are you finding opportunities, and where at this point?
Well, every day is a new opportunity, and as you pointed out, healthcare these last few days has been super strong. I mean, not just AbbVie. Look at Amgen. Pfizer today was real strong, and then United Health has been made a new all-time high yesterday when the markets were getting pasted. So I think you look outside there. I guess the important point here, Dave, is that money is still flowing into the markets, and even with a hawkish Fed and lack of liquidity in a lot of different areas, we do still see money flowing into stocks. And it may not be the sexiest areas. Today we saw retail. We saw big numbers last night from Costco, and it dragged up Target, it dragged up Walmart, it dragged up Dollar Tree, Dollar General, and a few other retail names. So, there are some pockets of strength out there. They're certainly narrow. It's not your, Facebooks and your Amazons anymore, but it's these other areas. So if we're able to be flexible enough and step outside our comfort zone, which is, a lot of people have just been very comfortable making money in those names, I think we're going to do pretty well.
It's an amazing market where you have so much choppiness, but I'm not struggling to find it. You just rattled off a bunch of stocks that are making new highs this week, so they're out there if you know where to look for them. Bob, listen, it's great to see you. Really appreciate you stopping by and sharing some thoughts with us. Stay safe, be well, and we'll talk to you again soon.
Have a great vacation, Dave. Thanks. We'll see you when you get back.
That's Bob Lang. Bob's the president of Explosive Options. I think he summarized in about 5 minutes. I think exactly how this market feels to many market participants. It's frustrating in some ways because you have these signs of deterioration and some of the breadth measures that Bob was highlighting there. New high, new lows outpacing new highs. Stocks breaking down through moving averages. All of that sort of indicates this internal weakness, particularly in growthy areas of the market. However, when I screen for stocks making new highs and new lows, like I did yesterday for my market misbehavior premium members, it was 50-50. I had about 100 names making new highs and 100 names making new lows in this environment. So there are stocks out there that are working. So when I talk about it being a stock picking environment, I think there are really good opportunities, great opportunity, particularly if you're using stock charts to be scanning for ideas, using the alert system, looking for stocks that are improving, because I think they're out there. That was a great take there from Bob Lang. He summarized, I think, this market environment very, very well. Let's continue on with our next segment, Getting Sentimental. We like to do regularly, usually on a Thursday, is look at some of the sentiment indicators that we follow and focus on how those signals are evolving. Now, having said that, Bob, I think, talked about the VIX and the VXN, which is the volatility of the Nasdaq 100. We're going to look at the regular VIX, if you will, looking at the S&P options. And if you look at this, it's essentially hit 20. And what's interesting about the VIX is I think of volatility in terms of volatility regimes, right? The VIX is not bounded like an RSI where it goes from 0 to 100, and below 30 you could call overbought, and above 70 you could call oversold, and above 70 you could call overbought. It's a little more nuanced, right? Because the entire volatility of the market tends to shift. In 2019, the volatility in general was very low. That all changed in 2020. The end of the first quarter, we accelerate up, and all of a sudden the VIX is in a much higher range for 2019. 2021, we started to settle in to a little bit of a lower VIX between about 15 to 25. What's happened in the last 6 months is the entire range has started to bump higher. And what we're seeing year to date is the VIX is kind of bottoming out in the 20 range, and it's topping out just above 30. So if you go back to the December low of last year, the VIX just above 30, the S&P bottomed out. In late January, you had the VIX above 30 there. And here in early March, we had the VIX go above 30. So the VIX hitting above 30, at least in the last 6 months, has been a pretty good indication of extreme volatility to the upside relative to where we've been. It's tended to coincide with market pullbacks or with market bottoms. On the other side, I'm finding about 20 is sort of the level to look at. Back here in early February, the S&P rallied up to 4,600. The VIX hits 20 and rotates higher. So right now, we're at that same level on the VIX that we were at those February peaks. So the market, again, is hitting 4,600 and stalling out a bit, just like it did back there in February. So if you're bullish, if you feel like this market has more upside to be had, if you're looking for the S&P to hit 4,800, 5,000, you really need to be bottoming out here and turning higher. And particularly, you need volatility. I would imagine the VIX to remain relatively low, because that would be the environment that the S&P is able to mount a further move to the upside. You want one of those slow, steady gains like we saw in mid-2021. I just don't see that happening. It certainly could, and it's a possibility, but I think it's much more likely the volatility starts to increase from here, that the S&P is flat to down, at the very least backing and filling and chopping around in this area. Again, while the S&P is at the same level it was in January, mid-January, just as we talked about, there are plenty of stocks that are working and plenty of stocks that are struggling. So it's a really good time to look for opportunities. Now, some other sentiment readings we like to look at are looking at survey data. This is the AAII survey, American Association of Individual Investors. We can see about 25% bulls this week. That's down from just over 30 or right around 30% that we've seen for the last couple of weeks. So bullishness coming off a bit this week. Bearishness actually increased in a pretty big way. It was below 30% last week. It's now above 40%. So we're back to bears far outnumbering bulls. That was a 1 week move apparently last week, where the bounce in stocks got a lot of people bulled up very quickly. Over the last 2 weeks, you saw a rotation away from a very bearish reading, but now once again sort of accelerating back, and you have renewed bearish sentiment just on the pullback that we've seen earlier this week. Who was it earlier that talked? Mike Siccardi, I think it was yesterday, that was talking about the spread between the two, and how the average spread from bears to bulls so far year to date is the most negative it's been in a long time, in a number of years. If you missed that interview, by the way, go to StockChartsTV.com. That's our on-demand platform. And my conversation with Mike Siccardi yesterday talked about sentiment in that particular form and why that's an important gauge to watch. The NAAIM Exposure Index is the National Association of Active Investment Managers. This is showing you survey respondents, how much are you allocated to the equity markets. In really bullish environments, it tends to be leveraged longer over 100%. In really bearish positioning times, it's sort of below 50% equities. If you look back at the last 7 years, you can see those times when it's dipped below 40 or 50%. These have been the major pullbacks that we've seen so far. So about a month and a half ago, 2 months ago, early mid-February, we got down to around 30%, which is one of the lower readings that we've seen in quite some time. Only a couple times in the last 5 years that we've gotten that low, back in 2020 and then back in 2015 and 16. We've spiked back up just fine, and now we're just above 83%. When I look back at the average readings, it's just about that. The average is probably just below this, but not far off. We're sort of right at the middle range. So arguably, it's a sort of a net neutral, I would say. The Ridex flows, by the way, which had gotten very, very negative, showing you that people had been very bullishly positioned within the Ridex family, had actually taken a lot of that risk off. And from December of last year to early March, there's a big risk-off movement within the Ridex family, going to more of the cash and money market sort of cash-like funds within the Ridex family. A lot of that has come right back in, and with the bounce that we've seen off of the lows, you've seen people once again be more bullishly positioned. So in general, elevated levels on this chart, it's actually plotted inversely. That means a very low level to the ratio, which means people are on the bullish side of the coin. That tends to be what happens in extended bull market phases, but often traditionally I would look at moves higher in that, significant moves higher in the Ridex flows, and think of that as a contrarian sell signal because people are getting too bullish too quickly. Potentially what we're seeing off of these lows in March. We don't have time to talk about this one, but put call ratios were the other two that I would mention to you. Put call ratios in general, a little more elevated. We've seen a lot of choppiness in these ratios. They've been very elevated in February and March, coming off of it, but now rallying back, sort of in the midpoint of where we've seen for the last 6 months or so. We need to wrap today's show, folks. Go right to the 3 in 3, 3 charts in 3 minutes. Here we go. Chart number 1, we're actually looking at advancers, decliners. I really appreciated Bob Lang joining the show today. I had a couple charts that were really interesting, thinking about breadth, some breadth looks that I don't look at as much, which is always really valuable. I wanted to highlight this chart for you and just zoom into the last couple weeks, looking at the percent of stocks up on the day on the New York Stock Exchange, the percent of stocks down the day. So this is looking at advancers as a percentage of the total listings, decliners as a percentage of the total listings. The only thing I wanted to highlight here is on a couple of these up days recently. Forget about the move down to the March lows. We had the rally into late March. We've now rolled over with the S&P back down below 4,600. What concerns me a little bit is some of these big up days like we saw here. You only had about 50% of the NYSE closing higher. Today, we had an up day with less than 50% of the NYSE closing higher. So actually 54% of the, not the S&P, the NYSE, over 50% of the listings there were actually down today, even though the S&P was higher. That's a concerning reading for me because the down days are getting plenty of negative breadth. The up days are getting meager breadth, and that's not an encouraging sign. Chart 2, the VIX, $VIX. We're looking at the VIX down around 20. That's right where it was at the February peak. I'm concerned that I'm seeing a similar reading as we pull back off of that 4,600 level. Are we getting a similar reading, a market peak, and a VIX of around 20 that we saw earlier this year? Finally, Goldman Sachs. I always remind people, when in doubt, look at the charts, focus on the highs and the lows. I was lecturing to the students at Texas A&M University just a little earlier this morning. We were talking about this particular chart, Goldman Sachs. They're asking about stocks that were rallying. We looked at AbbVie. We looked at some other names there. On the downside, we looked at Disney and we looked at Goldman Sachs. They're just examples of stocks in downtrends. What I noticed as I was talking to them, two things. Number one, a consistent pattern of lower highs and lower lows. Something like Goldman gets back above its 50-day moving average, I think it would be cause to get excited. Until then, though, that's a long way up from where we're at making new swing lows today. As we're making a new 52-week low, though, I just wanted to highlight it is a hammer candle. If you know your candle patterns, you know that is a one-bar pattern where you have an open and close near the top. A long lower shadow usually means a bit of a short-term reversal to the upside. Friday may be a nice day for the nice bounce higher for Goldman and the rest of the markets. Folks, that's a wrap for this show. Special thank you to Bob Lang from Explosive Options joining us, sharing with us 3 fantastic charts to nudge our thinking. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.